Prop 13 helped buoy the California market for decades.
For decades. Yeah. It's nuts because you think about like, I mean, how beneficial it is to me personally, but to my kids,
Yeah.
they're screwed.
Right.
Right.
Yeah.
Because they can't buy. And it's funny because so that's what's tricky. Like you have to vote to get rid of this massive tax break because it just destroys the market for anybody who wants to buy in the future. It's really a tricky space.
A lot of tricky, dysfunctional stuff for sure. Okay. Yeah, so the investor market has expanded dramatically. Of course, the institutions are playing in a very big way now, but compared to the overall market, though, for buy and hold single family rental homes, they're still not that big a deal.
They're still like 5% of the market.
It's but they're getting bigger. Okay. Yep. So, it's something to watch for sure. But that's more than ever before. So in other words, a lot of these properties are being taken out of service to buy and hold investors. And that's also limiting the inventory. Now, Mike, I want to, speaking of that, before I forget, I want to throw a prediction, okay, that I've been making for about 1.5 years now. Tell me if you think this is true. I think that the low interest rates we've had are actually going to lead to a further housing shortage. Because 3 years from now, 5 years from now, let's assume interest rates are probably going to be higher. I think that's a pretty safe bet given how low they are now. They don't have anywhere to go but up. People are not going to want to let those properties go with those cheap mortgages. They're just going to want to keep them. So I think this bodes well for the home improvement business and the remodel business and the add an extra room business, add on to your house business, because people are going to be more likely to stay put, or like you said, they're going to keep that existing home that they're occupying now as a rental because that cheap mortgage is going to be just impossible to duplicate.
It's going to be cheap forever. So I 100% agree. And I've been talking about this same phenomenon, and you can see cheap rates that have been getting cheaper in this inventory chart each year. For example, the one time in the last 6-8 years that rates rose was in 2018, from like April to December of 2018. And what happened was you can see that the beginning January of 2019 started with slightly more inventory than the year before. It's the only year in the last decade that that's been true. And that's because for that 8 months, rates rose, and it was a little more expensive to own both properties to invest. And so a little bit of inventory built. And then this year, in the last 18 months, rates tanked. And it was a really good time to have the second property, to own the investment property. And so people went in droves during the pandemic. And so in our view, we don't see any signal except if rates climb, we can expect a little bit of new inventory. If rates climb and stay persistently higher for several years, maybe we get closer to back to the old way. But everybody.
But the interesting thing is about that is the inventory that will be the new inventory would be new construction from builders that don't turn those into build for rent, right? But also, again, you have that problem of people not wanting to give up these mortgages. So people in financial hardship, they'll have to give them up. People that just don't want to be an investor, they'll give them up. But there's going to be a big incentive to hold on to your house.
Sure are.
And that's why I think these low interest rates are so toxic and dysfunctional to the overall economy. It's kind of like this. I mean, look, you live in the Bay Area, right? So you understand rent control, okay? Yeah. And one of our team members lives in San Francisco. And he and his wife rented this place, a Victorian, I think, in 1996. They're now renting a place that is worth well over $2 million for about, I think, $2,700 a month or something. Okay. They're just not moving.
Yep.
Like these people are just never going to move. They cannot duplicate that deal anywhere else. So what that does though, is it makes the market dysfunctional and stagnant, because there's no sort of clearing, right? And repricing of stuff. It's just very unusual. And I think that's part of this interest rate problem.
I think that's exactly right. And we can see it in the inventory. We can see the inventory decline as rates have declined. It's been more and more common. One of the other things, Jason, that'll happen is as rates climb, let's say mortgage rates climb to 5%. Now, one of the phenomenon of investors has been, if rates are 2.8 and I buy my second home, it's really a good deal to keep my first one.
Yeah.
If rates are 5 and I buy my new home, I maybe can't make 2 payments. So even though I had a really good deal on the first one, I might give it up to make my new 5% payment. So you'll get a little bit of there, but
you will, yeah.
But just a little bit, right? Americans have a really good deal on their mortgage. It's also why in California, you may, if you're not from California, you may not realize this, but California, because of Prop 13, your property taxes never go up.
Yeah.
So that's like a massive rent control for the whole state of homeowners. And as a result, California per capita has the lowest available inventory per capita, and therefore the highest prices. Like it's a direct, and it is.
Prop 13 started in 1978. Howard Jarvis did that, and we'll see if it can last, because they're already attacking that, as I predicted they would, and they did to some extent just last year or the year before. But again, I think that's going to be progressively. I posit that if California never had Prop 13, the prices would have never risen the way they did in California. Yeah. Prop 13 helped buoy the California market for decades.
For decades, yeah. It's nuts, because you think about, like, I mean, how beneficial it is to me personally, but to my kids, they're screwed.
Right.
Yeah. Because they can't buy. And it's funny because, so that's what's tricky. Like, you have to vote to get rid of this massive tax break, because it just destroys the market for anybody who wants to buy in the future. It's really a tricky space.
A lot of tricky, dysfunctional stuff for sure. Okay. So we know that inventory is only about 1/3 of what we consider normal, right?
Yep.
So we're missing 2/3 of the inventory in the market, but how high can that push prices? It's so interesting because we don't know what the upper limit is. Nobody does, right? Is it going to be that Midwestern markets or Southeastern markets that are inexpensive now are going to someday have the kind of prices that, Hong Kong does? Right? Or Singapore or London or Paris? I mean, how bad can it get in terms of the prices?
Yeah, that's a good question. I don't know where that is. I do know that, you can look at affordability in terms of the payments that people make. And the payments that people make, are more a function of interest rates, mortgage rates, than they are of the price itself.
And they are low.
You
adjust payments for interest and inflation. Real estate is actually quite cheap in a lot of places.
Yes,
yeah,
exactly. And so I don't have any ability to predict interest rates. I like to say, I bought my first house in 1996 and I locked in my rate at 8.25 because I was afraid rates were going to go up. I bought my next house in 2001 and I locked my rate in for 30 years at 6% because I thought rates were going to go up, and I keep locking it in. Right. And I don't know where they're going to go. Yeah. It feels like they would go up, but who knows? That's interesting. But the other side of that is the demand coin. And I look at the millennials, who are the biggest population group ever.
Yeah, 80 million.
Hitting their peak earning and buying years.
Yep.
And that's got 5 years of growth to happen. So, we're in this low inventory, low supply, high demand for 5 years and at least. And then the question is, what are the other things, like, do mortgage rates climb? Does that tamper, do we hit some kind of big recession? Does that tamper demand? All of those variables have yet to be seen.
Yeah. And so just to add on to your comment, the oldest millennials today are about 40. Okay. Millennials aren't so young anymore, folks. Okay. They're about 40, and they will hit their peak earning and spending years in about 6 years. So that's the leading edge of the millennial generation right there. And after that, I mean, if we don't create more supply, we have problems. The real estate market really does have a serious imbalance, doesn't it?
It sure feels like it does. There's some good signs in construction that we've got some new construction coming to market, and it feels like we're finally not underbuilding, and we'll end up where that takes us in the future.
Okay, what else do you want to show us? More charts?
Yeah, we can do more charts. So I mentioned price reductions.
Mm-hmm.
So a lot of times when I'm talking to a broad audience like yours, there's at least a group of folks who are waiting to invest till the crash comes.
Right.
And so one of the leading indicators we can see is the percentage of homes on the market taking a price reduction. In general, nationally, you can think about that as a rule of thumb is 35%. So 35% are the sellers who want too much, or sometimes it's strategic, sometimes it's accidental, but they overprice and they take a cut before they sell. About a third. As the market heats up, then it's maybe 25%. And so you can see each year this range where the market trends. And as the year starts, price reductions are low, transactions happening quickly. As you get closer to the fall, people start cutting their price to move the home. You can see the highest point in here as it was at the end of 2018. That's when mortgage rates were rising.
Mm-hmm.
And all of a sudden, some people were caught by surprise. And so they cut prices. So sellers were caught, like demand weakened a little bit, and you can see it in price reductions. Mm-hmm. So 2018, 37% with price reductions. The year before, it was only 33%. You could see where that happens. So if you have a hypothesis that demand's about to crater, and I think if demand craters, then I'm going to swoop in with my cash, one of the leading indicators you can watch are price reductions. And you can watch demand cratering. So, and last year, we had this craziness where the cycle never happened, because in the fall last year, there was way more demand than was expected.
Right.
And so fewer people had to cut prices. Then this spring, we had the craziness. And so by April 30th or mid-May, only 15% of the homes needed to take price reductions. Normally it's 35, only 15%. Only the really wackiest ones that were overpriced.
And is that like per week, or what is that?
So it is, of the homes on the market now, 30% of them, as of right now, or of the 28%, have taken a price reduction sometime in the last 90 days. So have taken a price cut. So it's not like 30% are cutting prices right now. Okay, how many of these were overpriced and taken a cut?
Okay, got it. So just to sum that up for the people who aren't looking at the chart, right? So back in 2015, kind of normal-ish market, 34%. The following year, about 34%, then 33%, about the same, right?
Yep.
And then during that slowdown part, 2018, rates went up, and we saw price reductions spike up to 37%.
Right.
Okay, so that's a difference. Now, coming out of the pandemic, or the lockdowns at least, we saw price reductions go down to like 26%. So they're way lower. They're about 10 points lower than the prior 36%. But then at the peak of the market frenzy, they were down to only 15.8% reducing their price. Now, getting back toward the normal direction, we're at 27%, but still much lower than usual.
Much lower than usual. And if you're in the market right now, you know that that's true, right? That you know that there's still lots of demand. You know that if you're overpriced now, you're more likely to have fewer bidders than if you did it in April. Like, you can see that, you can feel it. This number is also very local. So I encourage people to, you can go to Altos Research .com and grab reports and look at local markets. So for example, Phoenix typically has a higher, is like 45% at its peak, because there's more investor activity, there's more outsiders, there's those kinds of, there's greater inventory per capita, but it still has the same cycle. So when the bubble burst in 2006, 7, 8, you could watch this number climb to 40%, 45%, 50%. Half of the stock is taking a price cut,
right?
Because there's no organic levels of demand out there.
Yeah.
And when you see that, then you go, okay, now that, like, at that point, there's buyer opportunity.
Yeah. So I'll just give you an anecdotal story about that. I'm doing another 1031 exchange. I had my identification deadline on Monday. That was 2 days ago. And I literally sent in the form at about 11 p.m., which I had 1 hour left. And for 45 days before that, I was making offers. Everything, I just got beat out on every offer. I couldn't believe it. I finally managed to get 2 houses under contract, And I was so relieved that they didn't make me pay above full list price. I mean, as if I thought that was a good deal.
Yeah.
They made me remove many contingencies or shorten them dramatically: appraisal, inspection, financing. A 50% down buyer, huge earnest money deposit, still no clout. It's just they don't care. Yeah.
Right. And that's, though, slightly better than if you were buying in April of this year.
Yeah, right.
And you can see it in the price reductions data, right? You can see it in this chart right here. What it says right now is that we're still far hotter market than, quote, normal.
Yep.
It shows us that we're backed off the frenzy peak, but it also shows us that if you notice, we're at the far right end of this chart here, we're ticking down, just like we would at this time of year, which means if you had a hypothesis, for example, that you thought people coming out of forbearance were going to flood the market with foreclosures,
that's just not happening.
Not happening. Yeah. And you can see it not happening, right? Because if they were there, they'd have to cut prices to keep up with them. So it says all of those things. It shows us how we're set up for a strong first half of 2022, because these are homes that haven't sold yet.
That's true. So inventory low and price reductions not very high.
Yeah, low for this time of year.
Right. And do you track, well, you don't have any way to track multiple offers on a property. Do you track homes that sell above list price? Well, you wouldn't know that till they close, right?
Right. That's exactly right. So we don't track things like homes above list price, but here's what you can do is you can see it in this data, right? You can see the same phenomenon happening. Back in May, when it's 15% with price reductions, you know that's also the exact peak of multiple overbid offers. So they're just tightly correlated. It's just another way to look at that. But you can see it here before the house closes. So you can see it earlier in this data.
Right. Very good. Okay. Give us one more, and then let's go to some local data, Mike.
Okay. So let's look at days on market. So days on market, this is looking at the active market. What we know right now is normally, you can see normally it might be 11 or 12 weeks this time of year. And you can see a normal seasonal curve. It's later, it takes longer later through the holidays than the January, the first quarter comes out, you get new inventory and days on market declines. Last year was nuts. It dropped in the fall and stayed low super late. And that was showing us how we were set up for a strong first quarter. Right. This year we had the peak of our frenzy was only 21 days on market for the whole country.
Wow. So folks, remember something, what Mike said, this is every house for sale in America. The average on market at the peak market frenzy was only 21 days on market. Right now it's 42 days, but a normal market is what, 77 to 84 days?
That's right. So
that's sort of normal.
That's right, normal. So now you're 3 months, you're 4 months in that range would be normal for this time of year, right? You're like, now it's November and you got the holidays, and then it goes even up higher because people don't buy stuff over Christmas, and then it finally resets in January. So what this is telling us again is this number is not climbing super fast. So we know that demand's not going away. We know that it's staying unseasonably strong. We know that in the super bullish markets, a lot of the junk clears out. And so the junk that sits around for a long time is all of a sudden not sitting around. So we can see all of those things that happen. It's one of the other sort of bullish leading indicators for 2022.
Yeah. Wow. Yeah. This market is tight for sure. Mike, you were kind enough to share some of your local market data, especially for markets that our investors are buying in. Let's look into that. Remember, folks, all real estate is local. It's good to look at a national overview because you just get a sense of what's happening, but all real estate is local. So we are looking at the Altos website now.
Yeah. And so you can go to the Altos website and you can get local data. You can run a report and get local data. And we pulled up a few where your investors are working in the Southeast. I live in San Francisco. I don't know anything about Ocala, Florida, but let's look and see what we can see immediately about Ocala, Florida. First thing to know when you look at Altos reports is we have this market action index. It is at a glance answer, how's the market? It uses supply versus demand. It uses we know exactly what the inventory levels are and where it is to normal. And we know demand. We have a bunch of indicators of demand. So this thermometer, or this speedometer, when it goes up, that's a hotter market. So right now that's a 30 on this scale is balanced, like a balanced buyer sellers. And it's a seller's market, obviously, right
It's
now.
at 64 out of
64
100.
out of 100. Okay. And we could look, and I'm sure, earlier in May, it was even higher. Yeah. We can look at, and so each of the data points here, price of new listings that we talked about, price, these are all what, if you walk into the market right now, these are the homes. This is
okay.
What
So,
you could see right
compared to what we were just talking about, right here in Ocala, Florida, 30% of the listings have reduced their price, right, and 6% have increased their price.
Increase their price. So those are flippers.
Mike, when it doesn't sell, you just raise the price.
Exactly. But that's what's interesting is you can tell that Ocala is an investor market, because there are 6% really high. Right, those are fix and flips, those kind of things that come in there. But let's look down here in the big chart, so you can see what's happened to prices over the last few years in Ocala. They've gone up. And like continued to just fly this year. But if we switch this to our percent with price decreases, so let's look at this number. So here's 3 years of data. Normally in Ocala, the past few years, here's your 30 to 35% range. And then last year at this time, it was down to 27%. And then here's April, May, 16, 15, 14.
14.5% taking price decreases.
That's right. Yeah. So 14, that's right. 14%, only 14% of the homes, like you think about all the crazy sellers who overpriced, only 14% had to cut their price to get the deal done. That's increased back in Ocala, and we're at 30% right now, a little closer to normal.
Yeah, right. You know what's interesting about that though is, it doesn't necessarily answer the compared to what question, because of course the price they set, there's no barrier to that. Anybody can set any price they want, but you have to kind of assume that they've always done that, right?
Right.
So when you compare it historically, people were crazy and wanted ridiculous high prices in 2012, just like they do in 2021, right?
That's exactly right.
Yeah. Okay.
And buyers know it. Right. So what that's showing is that, it's at 30% instead of, 34 normally. It's that, so that is bullish, but not nuts going into next year. That's actually encouraging to me, right?
Yeah.
Nuts is a little scary. Here's another thing I like to point out in the Altos data is we do every market in the country, every zip in the country, every city in price range segments. The high end of the market may be behaving differently from the low end.
That's very true. Yeah.
And so you look down, you scroll to the bottom of your Altos report, and at the bottom here is about 190 grand. The lowest 25%, under 200K. That's Ocala, Florida. The high end is 600K. And we can look at a few things. We can see that the high end is, these are 1 to 2.5 acres, where the low end is half an acre. So you're not going to buy a $190,000 house, remodel it, and sell it for 600.
Right.
Because you can't build a lot. But you might be able to go from 200 to 350, because those are the same lot size.
Right.
You could see these are 1,300 square feet to 2,000.
Right.
You can see the age, what you're buying in that range. And then you can also see the days on market. So the fastest moving stuff in Ocala is 21 days.
Is the cheapest stuff.
Is the cheapest stuff.
Yeah.
That's not always true, but in Ocala it's true.
But mostly I'd say that's going to be true.
In general, it's true, but in some of the markets, especially some of the investor markets, the lowest ones are real junk.
Yeah, so they're the real, really stigmatized properties in really bad neighborhoods.
And they take longer to sell. And we can look, and we might notice that somewhere. What's interesting is when the subprime bubble burst in San Jose, California, you could watch days on market. The expensive homes, the multi-million-dollar homes, were going fast or slower than the cheap homes. When subprime burst at that time, you couldn't get a subprime loan, and all of a sudden that flipped. You could still get $1 million mortgage but you couldn't get a $500,000 mortgage because those were subprime buyers. And so at that time, we could watch this. The things that were moving in San Jose were the $1 million plus homes, and the cheap homes wouldn't move at all. It was really fascinating. So
it also says something about the concentration of wealth when you get to the ultra high end, because the rich are definitely getting a lot richer.
You could see it. You could absolutely see it there.
Yeah.
So it's a fascinating way. When I bought my house in Silicon Valley in 2001, one of the things I did was I bought the cheapest little old piece of junk, in a very expensive neighborhood. And my plan was to remodel. And what I wanted to see was, could I go from the lowest quartile, the lowest segment, with a remodel to maybe the third segment. And we can track price per square foot at that range. So we can see, and what allowed me to do is say, I can add 1,000 square feet onto this house. I bought 1,000 square foot house, I had $1 million mortgage. And then I could add 1,000 and literally double my money in value instantly.
Right. But that's not necessarily the house in the same school district or, whatever. Right.
So, in this case is Ocala, but we can look in the zip code and you can look at and dive down into.
Let's look at Jacksonville or Memphis.
Okay. Let's look at Jacksonville. So Jacksonville
so it's a 66. So it's a little busier than Ocala ever so slightly.
Yep. And pretty stable from last month. If we look over here, we can see that earlier in the year, it was even hotter in Jacksonville.
Like most everything, right?
Yep. Exactly. Here's our price decreases is at 37%. So let's look at the trend of price reductions over time. So like Ocala, normally, so Jacksonville, because it's a bigger market and has, more turnover, normal in Jacksonville for price reductions might be 40 to 45% price reductions. Last year, it was 35, 36. Jacksonville's lowest was 21 this year. And now we're back at the 36. So we're back to a hot, it's still hot. It's not insane. But it's not climbing from here. So we're like setting up for a strong.
Interesting stuff, Mike. This is fascinating. And I know we could go on this stuff forever because it's so interesting, at least to nerds like us, right?
That's right.
But the website is altosresearch.com, right?
Yep.
Okay. And you can get free reports on local markets there. Is there anything else you want to share with people as you wrap it up?
You can also go to the Altos Research YouTube channel. We do the national reports every Monday. And so you can keep on top of this data every week. Follow us there, subscribe to the Altos Research YouTube channel. And especially if you're an investor, if you've got investor clients and your realtors, you can sign up and you can put your Altos reports, branded for you, in the inbox of your clients, your sphere every week. And that's how you really keep them informed. That's how the systems work together.
Good stuff. Mike Simonsen, thank you so much for joining us in this wealth of information. We really appreciate it.
Jason, it was a real pleasure.